Hello, everyone. Thank you so much for joining me, Fawad Razaqzada, market analyst with Think Markets. Today in the room, we have Victor from Sofia in Bulgaria. He's also our analyst. And together we'll be presenting the live market analysis webinar, which happens every Tuesday at 11:30 London time. So we're gonna put a recording of this webinar on YouTube. So if you want to watch this later, you can do that. You can do so when it's uploaded there. Now, before we begin the live market analysis webinar, please have a read through the risk warning, and I'm going to read the first paragraph with you. These webinars offer general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Now, the format of this webinar is really simple. You ask questions and we answer. We provide mainly technical views on any markets that that are tradable with Think Markets. But we also talk about the major currency pairs anyway, as well as some indices and gold and silver, like we do usually. But we'd love it if you guys ask us questions, and we want to keep this webinar as interactive as possible. It lasts about 30 minutes. As I said, it starts at 11:30 London time, and the fundamentals will be very brief. So it's going to be very technically focused webinar. Now, there's not much happening this week in terms of economic data. We have got a few, maybe a handful of important macro data, not many to mention, to be honest. So what's keeping the markets, driving the markets at the moment? Well, I think it's ongoing optimism about things turning to normal again, hopefully in the not too distant future. After the recent development and the deployment of vaccines now. So that's keeping the stock market bears largely at bay. But at the same time, the latest lockdowns are continuing to hurt economic growth, and that is providing some signs of concerns for equity market bulls. Overall, though, it's still a rising trend for the equity markets and risk assets in general. So that has also obviously raised hopes over stronger demand for things like crude oil and other commodities. So commodity dollars have been rising, generally speaking. They have come down a little bit off their highs, but the trend has been bullish for commodity dollars as well as emerging market currencies. The pound has been one of the major beneficiaries of the weaker dollar. I think it's going to be one to watch this year because a no-deal Brexit has been avoided now, which means that investors are going to price out the risks of a no-deal exit in the weeks and months ahead. And once the UK comes out of lockdown, and given that the deployment of vaccines, the UK has been the first major country to deploy vaccines, and not to mention all the stimulus that's been introduced in the UK, not just from the government, but by the Bank of England as well. I think that the UK economy is going to hopefully rebound really strongly relative to her other partners. So I think the pound is going to be one to watch this year, and we're going to cover the pound in greater detail when we look at charts. In fact, let's look at the live charts straight away because we don't have too much time to spare in this webinar. And before we talk about the pound, I normally start off with the dollar index. So let's start with the dollar index again. And the dollar index has been in a downtrend since March of last year. The dollar has had periods where it looked like a low was formed, for example, in August of last year, before it started to push higher again. So in recent days, we've seen a rebound in the dollar. Is this a key rebound? Is this the low that the dollar has formed, or is this another short-lived rebound? I am of the view that this is just a oversold rebound and that the dollar is going to weaken further over time, because I expect the ongoing risk-on trade to keep the pressure on the dollar. So for that reason, I think the dollar index is going to go down again. And also from a more technical point of view, it's the location of the rebound that's kind of making me worried if I was a bull. Ideally, I would have liked it to go down below the 2018 low, which is this low here, before bouncing back. If it had done that, then I would have been more inclined to say that the dollar may have formed a low. But the fact that it's left this low untested, this is what makes me think that this is yet another, bear trap. Sorry, not bear trap, bull trap, and that renewed weakness is just around the corner, and that the dollar index is going to go down from here to take out liquidity that would be resting below this low. So I reckon the dollar index is going to turn lower from one of these resistance levels I have highlighted. The first one is at 90.50, which is literally this low here. As I zoom in, we have tested this level previously, so it's not a very strong resistance level, I don't think, but it is there nonetheless to, as a level where the dollar could indeed turn lower from. We have broken the 21-day exponential, so that's important to note, because the 21-day exponential had kept the dollar under pressure significantly since November of last year. So that this now that this is broken, there is a possibility we may see a deeper retracement than the start of the next leg lower. But let's see what happens over the next couple of days. What we need to see from a bearish point of view is a bearish looking price candle at around the current levels to signal to us that the trend has turned bearish once again.
So from my perspective, I'm actually of the opinion that we might see some consolidation at the current levels.
Okay.
However, this retracement in the dollar that we have observed over the past 3 or 4 days, 3 or 4 trading days, that is, to me looks more like a start of a new US dollar bull cycle.
Okay, interesting.
I'm jumping in straight with some fundamental backdrop in order to explain why this could be the case. For starters, we are only 8 days away from a new president in the US, a new administration that is likely to materially reshape the way government is done in the States. As you have just opened the 10-year the 10-year yield, we're seeing a significant rebound. Break through key levels, break above 1%, and basically the reflationary trade is starting to happen. And bonds are dropping. We're going to see fiscal action, which actually could be good for the dollar, I argue, because up until now, the Federal Reserve's efforts have been focused on the financial system and basically on ensuring that markets function properly. But this huge expansion of its balance sheet hasn't been trickled down towards the real economy, and we need some fiscal policy in order to see that. And I think that this is exactly what we're going to get. Assuming that everything goes well with Joe Biden's inauguration in 8 days, I would think that that day, that inauguration day, could be the bottom in the dollar this cycle.
Interesting. Yeah, I mean, the dollar has, as you mentioned, been supported by the rebound in bond yields, and when bond markets move, you have to take notice. Which is actually, this is the reason why gold also fell as well, isn't it? Causing the precious metal to lose some of its appeal as a non-interest bearing commodity. So as far as the dollar is concerned, one thing that worries me about being bullish on the dollar just yet is because I was looking through the yield charts, and it's not just the US yields that have rebounded. So if it was just the US going up relative to German bonds, for example, German bond yields, I would have been more inclined to say, yes, the dollar may have bottomed out. It could well have bottomed out, who knows? But, we're seeing similar breakouts in the German 10-year above the 200-day moving average here. If you look at the UK 10-year as well.
Yes, but they're still negative.
They're still negative. Yes. Historically as well, over the last several years, they have been below US yields. So what we should be looking at, in my view, is the yield spread between US and German and also the UK. Yeah. So I think I have previously prepared some of those yield spreads. Let's have a look. If it's here somewhere. This is the UK one. No.
Yeah, this is the German one.
Yeah, it is the yield, but not the spread. I think that the spread is here. Hold on, I will. This is it. Yeah, yeah. So this is the euro dollar. No, the euro dollar exchange rate is this black and white candles. The yield spread between German and US bond yields is this blue line. So the logic is that if the US yields are rising at a faster pace than German yields, the euro dollar should go down. And we've seen that the yield spread has been declining over the last several months. Yet the euro dollar had been going up and up and up until most recently. So recently, the euro dollar broke down from its rising channel, as you can see. I'll show you in another chart actually, because I don't want to mess this up. Yields have been declining. So it's possible that the euro dollar may have formed a top here, but it's all well and good in theory. In practice, it doesn't really happen automatically, and it doesn't always follow the script. Because, for example, if you look at here, when both were rising together, and then you didn't see any kind of deviation in the exchange rate until a few weeks later, when the two assets went in their own separate ways. So this is something to keep an eye on, but it's not everything. But yeah, I mean, when yields do rise, you do have to take notice, as Victor mentioned. So now going back to the charts of the euro dollar. This is what I was talking about, the euro dollar breaking down from its bull channel. Do you reckon this is the turning point then, Victor, for the euro dollar?
Yeah, I think so. We might see a rebound towards the 22, 30 or even 50 area, and some consolidation between current levels and there. But I don't see it really going back above 123, and I would think that by year end we might see ourselves back at 110.
At 110, wow. Okay, that would be a sizable drop. 110 is somewhere here, right? So that would take us below the 200-day moving average if that outlook materializes. I have a very short, a much shorter term focus when looking at the markets than Victor does. Generally
sure.
because yeah, I'm more of a technical analyst, and you're more of a macro guy.
Yeah.
So for me, I say 120 is the major downside target for me, because that level was the previous breakout area, and it's kind of untested on the daily time. I think if it gets down to 120, there's a high, there's a big possibility, in my view, that we will see a rebound from there, because the fact that the trend has been bullish. And I don't know, if you think about the whole macro picture, yes, bond yields are rising, etc., etc. What makes me remain positive towards foreign currencies is the fact that, you know, hopefully we are heading towards more normal times ahead, and you know, European economies are going to rebound, because you know, travel is going to resume, I reckon, and things will start going back to normal. So I think investors will be seeking more risk in the weeks ahead, in the weeks and months ahead. And I see the euro as a risk-sensitive currency pair. So I am of the view that the euro can actually rise a lot further from here over time than break down. Yes, the short-term outlook has turned somewhat bearish following the breakdown of this of price from this channel, but slightly longer term, I still think that the euro is headed higher, maybe to 125, possibly above that, before it has a chance of breaking down significantly. But you know, let's see what happens. Right now,
We'll see what happens.
Yeah,
we can add in a beer somewhere in between, and
yeah.
Hope that we can share one by the end of this year.
Yeah, let's hope so. But yeah, it's, you know, it's healthy to have kind of different views. You know, if I repeated what Victor said, or if Victor agreed with everything I said, I don't think there will be much value in it. It's always interesting to hear and acknowledge other people's opinions, which I'm doing. And you know, Victor has reasons why he thinks the euro is going to go lower. So that kind of, you know, if I were to trade the euro dollar, I would think now that, you know what, I could be getting this wrong. So it's healthy to listen to other people's opinions and respect their opinions. And that's what I will do. So I'm not going to be significantly bullish on the euro going forward until and unless price action shows me. No, I mean the evidence is there in front of you. It's not as a healthy looking market as it was before. But you know what? It could just turn out to be a short-term breakdown. Let's see in the next few days. I think the trend is going to become clearer. If it starts to move away from current levels to the downside, then it would encourage more sellers to step in, because previously every time it looked like it was going to go down, for example here, you know, it broke this trend line, went down for a few days, and look how quickly it came back up and then resumed higher. So this could be another such scenario. You just have to be very careful in terms of how you interpret short-term breakdowns. Anyway, let's move on. We don't have too much time to talk about the euro. The pound, on the other hand, is still looking bullish in my view, because obviously a Brexit no deal has been avoided, and so far price action is looking bullish. Let me show you the weekly chart first. On the weekly, this 135 level is obviously massive, right? Because previously rates had stalled there on a few occasions, but after we had a deal for Brexit, you know, price came back down to retest this level, and we are bouncing back from it. So far, the weekly candle looks like a hammer bullish candle, which is obviously bullish. So from here, it looks possible to me that the next big level that price may reach for is the 140 handle, which is probably about 400 pips away from where we stand at the moment. So not too far away, in other words. But that is where I think price is headed to, because 140, as well as a psychologically important level, it's where price has really struggled in the past few years as well. In 2017, it did overshoot this level a little bit before coming back down. I think, as a minimum, I think it's going to go and test that level to kind of gauge the strength of the rally. And then we may get some retracement from there. But, if it breaks 140 and it closes on a weekly or a monthly basis above that level, then at that point, you'll have to think a lot higher. But we'll cross that bridge if and when we get there. So for now, 135 is the key level that needs to hold. If it does hold, which it looks like it is at the moment, then the next target objectively for me is 140. Going back to the daily, the cable has been stuck inside this bullish channel. So for as long as it remains inside that, there's no reason for me to turn bearish on the cable, because obviously from a macro point of view, as I said, a no deal exit has been prevented. So for me to turn bearish on this, there has to be some other macro factor. Yes, the UK is in a lockdown and the economy is suffering, but so is all the other major economies at the moment. So it's not the UK is not just alone in this.
Yeah, sure. The pound is looking very constructive, especially against the euro in recent days.
Yeah.
If you look at that chart,
yeah,
we are seeing prices approaching a key level of this trend line.
Yeah,
and a double bottom on the daily chart. Or
yeah. Can you see the chart? I've just shared it with you.
Yeah.
And
but once we break through this 89.30, well, I would say an acceleration
in a downward
of
move.
this move is quite possible, because there's a lot of it's been a long, very long downtrend for the pound against the euro, and the fundamental backdrop for this trade has evaporated over the past 2 weeks.
Yeah. So where do you think the trigger will be behind a sharp sell-off? What level specifically do you see that if that level breaks, the sellers are going to step in aggressively?
Well, we might see a retracement or a fake out, a fake breakout of the bottom at 89.30.
Yeah.
It's just the recent bottom, which coincides with the trend line, 89.35, 30, 35 area.
Yeah.
So
this level here.
Yeah.
Yeah.
So we might see a false breakout, a bit of a correction to the upside, and then a much deeper move lower, which could be very sharp.
Yeah. So that level would also take us below this trend line. The neckline of there's a head and shoulders, by the way, with the neckline coming in at 88.66. So there's lots of kind of targets for the sellers from here. If it breaks 89.30 and holds below it, as Victor mentioned, the next obvious level would be the liquidity below the neckline, which comes in at 88.66. Then thereafter, it's really anyone's guess how far lower it could go from there, because as Victor said, it's been consolidating for a long time. It's had lots of attempts to go higher, but each time it tried to do that, it's failed. And fundamentally, with the Brexit no deal being avoided, some of that risk is going to come off the pound support, which could weigh on the euro pound in the weeks and months ahead. So keep an eye on let's talk further about the pound cross, actually, because there is actually something to talk about, right, with the no deal Brexit, being avoided, and the UK economy potentially being the first to come out of the major lockdowns with the development and the rolling out of the vaccines. The UK was the first economy to do that. And so far, more than 2 million people have been vaccinated in the UK, and a lot more will be in the coming weeks. So hopefully we will get out of this sooner rather than later. So another pound cross that I wanted to talk about is the pound yen. Looking at the pound yen, because if you look at the dollar yen has been going up in recent days, supported by that breakout in the 10-year US bond yields. So yen crosses are all looking positive to me, and among them, the pound yen is the most important one to keep an eye on, for to watch closely over the coming weeks and months, because this one, as well as the fundamental reasons I've just mentioned, from a technical point of view, it's looking very constructive. Look at how price has been making higher highs and higher lows here, rising steadily over the last several weeks. And now it's taken out its most recent resistance, which comes in at around 141.25-ish. So that level is going to be our key support to watch going forward. The next level on the upside is the August 2020 high, which comes in at 142.71. So that's going to be the next upside objective from here. So I'm expecting something like this to happen in the coming days and weeks. Also, if you zoom out, you have a long-term bearish trend line, which has, I think it has been taken out now. It's this trend line here. Oh no, it hasn't been taken out. But a shorter term one connecting these highs has been taken out. So there are two trend lines. The longer term one is still intact, which as it happens come in around that August 2020 high at around 142.71-ish, making that level important technically. The other one has already been taken out, connecting the highs from 2019 with that of 2020. And after several attempts here, we've finally broken above that trend line. So the path of least resistance on the pound yen is to the upside. Any other interesting pound crosses, Victor, you're eyeing? We seem to have lost Victor there. So I'll just carry.
Oh, sorry.
Yeah, no worries.
To be honest, I haven't traded any other pound crosses in my life.
I don't blame you.
But,
I don't blame you at all.
you don't need that many currency pairs in order to bet on a rising currency. Exactly.
But what I do say is always select the one that makes the most sense. The weakest, yeah. Or the strongest pound cross, in other words, in this case. So
yeah. So I would say that right now it appears to be the pound Japanese yen.
Japanese yen, absolutely.
And coupled with the rising yields and rising stocks, it totally makes sense. Because as we know, the Japanese yen is a risk-off currency.
Yeah.
So while we are strongly in risk-on territory, it would be the most prudent thing to do.
Yeah. So previously, so the fact that we are talking about the yen, I just want to quickly look at the euro yen as well, because previously we were anticipating a breakout above this black level at 125.13, which happened, and then the euro yen went into a period of consolidation, and now it's kind of well, it broke above the most recent high, but it's kind of rejected it there. So keep an eye on this one. If it holds this trend line, which I think, I believe it can do, because the yen has broken down against the dollar, against the pound, and it's most likely to do so against the euro, then the euro yen is likely to push on from here to the upside. So this is another currency pair you want to keep an eye on, keep an eye out for as well. Let's quickly talk about gold and silver, because we are running out of time, and I know a lot of people are interested in our views on gold. So the last time we looked at gold, it looked like it was going to break out. It didn't. The previous high at 1965, it was not tested, and price came very close to that level before breaking down. Then I was looking at 1900 to see if price forms support there. We got a minor bounce at 1900, which was previously resistance, before breaking down. So we're back to square one now, and testing the 200-day moving average, which has in the past been a significant support, as you can see. And so far, we are bouncing back from that level and holding above 1850 support. Overall, this looks like a market in consolidation. It's stuck between a hard place and a rock. And for me to turn decisively bearish on gold, it has to break below the 200-day moving average now cleanly. Because until and unless it does that, there's always the risk that the long-term trend could easily resume.
Yeah, it appears that this is the last stand for the bulls. Once the 200-day moving average is out of the way, I don't see anything that can stop gold prices from falling significantly. Purely because it's in a rising economy and a rising stock market. It doesn't make much sense to hoard gold.
Silver, on the other hand, should be doing relatively better, because silver is deemed to be a
it's also an industrial commodity.
It's got
precious metal.
Exactly. So it's got many industrial uses, and with the global economy rebounding, you'd think that silver would be doing better. But like gold, it's kind of held in this kind of consolidation area, unable to break higher. Last week, it printed another bearish looking candle, but there's been very little downside follow through after we tested last week's low earlier this week. So last week, it created this bearish engulfing candle. We broke below that, but as you can see, silver has rebounded now, and it's kind of flat on the week now, which could be an indication that it may have formed a low. However, keep an eye on gold if you trade silver, because if gold were to break down, then surely silver is going to follow. Probably it's gonna not follow down as sharply as gold, but it will go down with gold, because the two assets, they generally do tend to go hand in hand. But the key level to watch therefore is 2450-ish, the low from last week. Below that is bearish. Just as we are talking about commodities, let's finish off with crude oil. Brent crude has been pushing higher and higher because the OPEC has been delaying its production output hikes. Most recently, Saudi Arabia decided to reduce its oil output after Russia decided to increase its output slightly. And at the same time, travel is resuming slowly, and investors are expecting travel to resume more robustly in the months ahead, when hopefully lockdowns are over. That's why prices of oil are rising. However, as prices rise, so too will production, meaning that the upside potential could be capped. So keep an eye on oil prices. I think they are reaching levels where it's becoming profitable for US shale producers to start ramping up production once again. And so the potential upside from here looks very limited in my view. the Brent would do very well to get anywhere near the 70-ish area. I think it's going to be a struggle. I think 60 is possibly a level where it could start to break down from. But what do you reckon, Victor? Are you also feeling a little bit bearish on crude oil now that prices have risen so sharply?
I'm not particularly bearish for now,
yeah.
Just because I don't see any imminent production hikes, and I don't see shale producers ramping up well into the 60s, I would say. I mean, that they need to be confident that the price level, the break-even price levels, which are right above $60, if I'm not mistaken, on average for the shale oil industry, or that is for the bigger producers probably. Yeah, I would say that this rally is could prove to be more relentless than we expect.
Yeah, that's a fair point. And on that point, I think we're gonna end the webinar just to very briefly look at the major indices as well. Just to mention that the fact that they are still looking bullish despite the recent weakness. The overall trend is bullish. This is the German DAX. UK 100 is the one that I'm keeping a very close eye on because of obviously no deal exit being prevented, etc., etc. And there's more demand for value stocks, which the UK has plenty of. So this area here, the shaded region, is the breakout area. I'm looking for a rebound from around that area to take us to new highs for the year. And with that, thank you so much for joining us. It has been a pleasure. Please join us on Tuesday of next week at the same time. And we will be providing you with our updated outlook on the markets, and hopefully things will have moved more significantly by then. So take care. Have a very good week ahead.
Thank you, and you stay safe.